one.
It is on.
Hey, yep. Okay. Good morning and welcome to FreightWaves Today. It's our second edition. I'm here with my counterpart, Julie Vandekamp. Julie, excited to have folks back. This is day two of the brand new FreightWaves Today, the daily show that is happening on the ground, in the market, in the supply chain. We are here to discuss it. We got a lot to talk about today. An enormous amount. There was some big news overnight. Tucker Carlson, Gord, who is a frequent follower on FreightX, has done his media tour. He was on Tucker Carlson's show. I want to show a clip from this because I think it's just really poignant what he pointed out. A really interesting thing talking about just what's going on in trucking and sort of the ground truth.
You know, I mentioned this gentleman who crashed in Colorado on Wolf Creek Pass. There's this thing called the donkey route, which is a human smuggling route that goes through Central America, and they have agents in India. You know, there's been a documentary about this. I'm not making it up. And these young guys in India who are, you know, they see videos of, you know, their co-ethnic friends here and cars and girls and houses and, oh, I'm going to go to America and make it. But, you know, they can't get visas for whatever reason.
Yeah, I think one of the interesting things is just this human trafficking piece has been driving a lot of the immigration sort of story for trucking. Trucking has attracted a lot of the drivers that, you know, and this is something that's really been talking about in terms of non-domiciled CDLs. Julie, you listened to this and you actually sent it to me. I think you flagged it. Yep. What was your take on this?
So yeah, I got home and I had some time to look at it last night and I could see that it was going viral on X and there was a lot of commentary around it and sent it to you and we were texting and I thought there were some really great parts about it. I loved that it's shining a light and giving attention to our industry that I think is absolutely necessary and warranted. I loved that he talked about some of the regulatory stuff, like the English language proficiency, the latest SCOTUS ruling, Delilah's Law. I loved that it was a real truck driver who had experience talking about it and kind of shining a light on what life is like for a truly.
And he's also an author. He's written a book about this issue. I mean, Gord, I've known Gord for many years. He is a provocative person. He says what he thinks on his mind. He's very passionate about the topic. But as you pointed out, he has real-world driving experience, so he knows it from a firsthand. The other part of that clip, because you know, there's this whole over an hour conversation, was one of the elements of the fact that a number of the drivers that are coming over here that are being human trafficked are basically setting up these GoFundMe accounts because they end up in accidents. They're unqualified to drive, they don't have training, and they end up in these situations where there are accidents, and they've had these GoFundMe accounts to raise money for their own medical bills, and even to, in some cases, horrific story where they have to bring their bodies home.
Yeah, I think that was one of the other parts that I found incredibly interesting, and not just for that purpose, like, okay, so they have a GoFundMe to pay for their medical bills. Who did they crash into and what happened? And is there a public safety issue? But I also found his quote. He said something about, you know, true professional carriers make sure to create a culture of a safety driver compliance culture, right? And I liked that he was shining a light a bit on that as well and talking about how important that is and how. And I liked it because I think that it reaches the general public, right? It has them thinking about our industry as a whole, the public safety issue as a whole. And I think it's a really important caveat to call out the difference between professional carriers who are trying to comply with federal regulations and others who just...
And those that don't. And we've talked about this being a two-party system where if you're compliant and you're operating, it's been a very difficult market. If you're not compliant, you've been making money hand over fist because you're taking advantage of the system. Right. I'm going to go to the second part of this clip because I think he brings this home for our viewers in terms of what exactly this means in terms of the freight market.
Many multi-generational American trucking companies have gone out of business in the last few years. So since 2022, the freight market has been in what some people call the Great Freight Recession. We're starting to come out of it here in the last few months. But, there's a website called FreightWaves. I'm friends with the guy that runs it and a few of the people that write there. And they have a section of their website called Layoffs and Bankruptcies. And they have people whose full-time job is to document American trucking companies going out of business or closing or drivers being laid off or having financial difficulties. And it's been humming for 4 years.
Yeah, I mean, it's funny, Julie. He points out, Gord, I think brings us home for those that are in industry. We've known about the bankruptcy situation. We've known about the endless supply of new drivers that have come into the business. I think he brings it home in terms of the economic crisis. So we've talked about the safety crisis. It's 5,000 people a year that die through accidents involving heavy-duty trucks. It is a problem. We know there's a security crisis. We had Michael Caney on yesterday talking about security issues. You also have this economic crisis. And some of these companies are multi-generational companies that have been through multiple generations that just haven't survived. Yellow is probably the most common thing for most people in the public, but there's so many other multi-generational companies. Yellow had its own set of issues, but Carol Fulmer comes to mind. That was sort of a household name in trucking for people that aren't in trucking. And you even look at the large public companies that normally are some of the most profitable. Heartland is a great example of that just haven't been making a profit due to the endless supply of labor and endless supply of drivers that are unregulated. Yeah. This is a major, major crisis. And I'm so glad, I think the most important thing to take away from this for our audiences is that trucking has never received more attention than it has. The New York Times gave me the opportunity to write an op-ed. That was an unusual thing for the New York Times to really dive into this topic in trucking. We've seen, Tucker Carlson, Gord has been on there twice. The Daily Caller had some clips on the SCOTUS Montgomery decision. You had the 60 Minutes episode a couple of weeks ago. You just have so much attention. Plus, you have the government really focused on trucking. I don't remember it ever being, and look, it's not all great things. And this is one of the things that I think, as I was talking to Derek Bars here in the studio a couple of weeks ago, one of the things that he said is, I wish there was more positive attention on the industry. Like, we as an industry have so much pent-up tension and frustration because we've lived in this great freight recession for the last couple of years and have seen this two-party system between folks that are following the rules that aren't doing well and folks that aren't following the rules that are actually getting creamed. That is frustrating. We have a lot of pent-up attention, but there's also things that I think should highlight what's great about this industry. Julie, real quick, what would you think of all the things you think that the industry should focus on that's positive? What do you take away from all this?
I mean, I think Gord has a story of someone who grew up around trucking, wants to be part of it, remains in it, wants to do it in a safe way and be compliant and avoid public safety issues and ensure that everyone is playing by the same rules. We heard that from Shelley yesterday. We heard it in the Tucker Carlson interview yesterday. And we need everyone to play by the same rules. And there's only so far regulation can go if it's not being enforced. So I think continuing to bring attention to it is incredibly important.
And these voices are important. I mean, Gord's a great example because he's such a provocative speaker. He's very blunt, very outspoken. That Canadian accent always gets me because he really is a passionate guy. He cares deeply about this industry. He cares deeply about the folks that are in the industry. And he, as many of us, want a more compliant industry operating. I think it's pretty remarkable. I would say it's an opportunity, I think, for us to educate the public about these issues. One of the things, I wrote this New York Times op-ed a couple weeks ago. There were over 1,200 comments before the Times shut it down at like 8 p.m. because they have a time where they let public comments. But that shows you, and this was all about truck safety and accidents. It shows you how important when we're able as an industry to characterize things going on, it shows you how passionate people are once they become aware of the crisis. Yep. Next up, we have news headlines. So let's see what's happening in the world of freight.
We kick things off with a massive legal win for shippers fighting off liability claims in the Lone Star State. Just one day after the Alabama Supreme Court decision in Montgomery versus Caribe Transport 2 widened broker liability in safety-related incidents, the Texas Supreme Court delivered a starkly different ruling in a case involving Home Depot and Warner Enterprises. The case stemmed from an April 2024 crash near Houston, where a Werner employee driver transporting freight for Home Depot reportedly ran a red light and killed a motorist. Home Depot was later added as a defendant, but Judge John Philip Devine ruled that The plaintiff's liability theory is not viable because it transforms the commonplace act of shipping goods into a basis for sweeping tort liability, untethered from control, conduct, and risk. The court agreed that one who hires an independent contractor is generally not liable for the contractor's torts, effectively blocking litigation against Home Depot. Over in the mergers and acquisitions arena, a major logistics consolidation is promising to reshape how small and mid-sized businesses ship freight. Dallas-based WEX Group and shipping software provider Octane have completed their merger, creating a new company called ShipStation Global. The newly formed company combines WEX Group's freight brokerage and transportation services network with Octane's portfolio of shipping technology products, including ShipStation, Stamps.com, Metapack, and Packlink. The merged entity serves more than 3 million customers and handles over 3 billion shipments annually with a sprawling network including more than 75 less-than-truckload carriers, 350 regional, national, and international carriers, and approximately 45,000 truckload carriers, backed by private equity firm Thoma Bravo. ShipStation Global's platform connects parcel, LTL, truckload, and international shipping services through a single interface. Finally, FedEx is pouring serious capital into European ground operations to support its aggressive pivot toward premium international air freight. The express giant is investing $54 million to expand a major truck terminal in Duiven, Netherlands, buying and developing a facility adjacent to its existing road hub. The project will increase palletized freight handling capacity by more than 50% and add 65 dock doors, bringing the total to 265 docking spaces on site. This European trucking network has become critical after FedEx reorganized its air network into express parcel and deferred freight segments, operating an international daytime schedule that integrates air and road networks in a truck-fly-truck delivery model. FedEx is targeting a greater slice of the $90 billion deferred air cargo market, particularly the $22 billion premium segment where the company currently holds just a 12% market share.
2, 1. Julie, a lot is going on. I think one of the most interesting stories is the Home Depot story. I think there's been a question since SCOTUS, the Montgomery decision, is are shippers going to be brought into court and going to have torts? The Texas Supreme Court says no.
Right.
That basically negligent hiring was thrown out in this particular case.
Well, I think that creates a few questions for me that I think we can talk about, and I would love your take on. So one, what does this mean they said shippers can't be held liable because they can't be responsible for ongoing monitoring the safety of federally regulated carriers. Mm-hmm. Clearly, brokers can and should be responsible for doing that based on the SCOTUS ruling.
Well, no, that's not what SCOTUS said.
Okay.
SCOTUS said that they could preempt.
Okay.
They said, or there was no preemption. They said, look, there is the potential of basically, there is no federal preemption when it comes to negligent hiring. That's what they said, preemption. That's the key. Every state, we now have 50 states that are going to decide this. Texas is one of those states that said, no bueno, you can't sue Home Depot. Negligent hiring is not their responsibility. It's not their problem. That case was thrown out, and I think it's a real precedent for Texas motor carriers. Texas brokers are probably rejoicing. Texas shippers are rejoicing.
Yes.
And I would say shippers say, God bless Texas Supreme Court. As a former, I have a Texas passport, because Texans feel like they're their own country. Yeah. I lived there for 20 years. They are certainly pleased with this decision, I imagine.
Yeah, I do. But I think it also asks questions, and I'm sure this is something that you and Matt could answer better than I could, but what is an independent contractor? Because that was part of the ruling as well, too, that even though the carrier was an asset-based, Werner, they were hired, not truly an independent contractor. Yep. They were looked at as an independent contractor, as a vendor.
I mean, that's hard. I mean, look, I think this is a really important case. I mean, if the example is if a travel agent sells you an airline seat, and that plane goes down, it would be hard to make the case that the travel agency made the mistake.
I think that's fair.
And I think that's been the counter argument. So we're going to see this I think is a really important thing, Montgomery. Before we go to the next segment, LMI came out today. What did you see?
Okay, so I saw some really cool things. Obviously, we've talked about manufacturing being incredibly tight. That's continued. We also saw the pricing for transportation reach the highest level ever. 96 was the score out of 100. Insane. In the 10 years of the survey, it's never been that high. And I think it also confirmed some of the things that we talked about. Manufacturing's tight, warehousing's tight, rates are up. Retail is probably next to be tight. And we heard yesterday that it is tightening. And then, so if housing starts or automotive ever pick back up and continue to get, create a little bit more freight, then it's really going to be sort of a crazy scenario when it comes to pricing already being at 96 and capacity being tight. If those volumes go up further, then it's going to be something we've never seen before, I think.
I mean, this is an absolute crazy market. Shippers are certainly filling it. And as we heard yesterday, it's not just manufacturing and industrials. It is retail and consumer that's also doing well. And you could look at yesterday's show with the Port of LA director, Gene Soroka, as well as Webb Estes talks about what they're seeing, that retail and consumer freight is absolutely hopping.
All right. So we have Aaron Graft joining us today. Craig, I don't know if you want to give him an intro.
Yeah, so speaking of Texas, our favorite banker in the state of Texas, Aaron Graff. Aaron, you are the CEO and founder of Triumph. You guys have triumphed over the payments business in the industry. You're the largest payment network in freight. Aaron, thanks for coming in the studio, being on day 2 of our inaugural FreightWaves Today.
Craig, I'm honored you would have me, and you're always welcome back in Texas whenever you want to come back.
That's surprising.
We'll honor your passport.
Well, my son is now at Baylor, and as a former, as you're a Baylor grad as well, he's at the best institution on the planet, as you know. But, Aaron, the last 2 times I have been speaking at your internal sales event, the market is tanked. So I'm glad you haven't invited me lately because we're enjoying this very robust recovery. Please do not invite me anymore to come speak to your team. But what are you saying right now? I mean, this is an insane market. As Julie just talked about, the LMI is absolutely ripping for transportation costs. We see it in rates. We see it in tender rejections. What are you guys hearing from your customers?
So I have a couple thoughts. Yesterday, I was in Chicago, and I visited with 6 of our largest carrier clients, and I have never seen more demand to add equipment, and that level of confidence that they're showing, it just has a different ring to it than 2021. And Craig, you and I both remember that time. And I looked at some things. Right now, our payments, we're doing about 50 billion annualized in payments, and the average invoice size, or what you would call the price per load, is $1,500. If you go back to 2021 and look at our payments network, that was $1,126, right? And then you adjust for inflation between those 2 points, and it's about 8% higher now in real dollars than it was, and those are full year 2021 numbers. And of course, you remember 2021 was a remarkable year because the government threw a party for all of us, and freight got the opportunity to cater it. This one's a little different, but the bottom line impact is revenue for our carriers are up. Other parts, of course, the supply chain are feeling the squeeze, as you just alluded to, but the move in the numbers is remarkable.
Yeah, it is a crazy time. I mean, I don't know if a party is the right term. It's a party that none of us wanted to be invited to unless you are a non-compliant motor carrier and absolutely printing money because you don't follow the rules, don't pay your drivers enough, treat it like slave labor. It's interesting you point out the expansion of fleets. And this is always the most dangerous part of the cycle because everyone wants to expand. It sounds like you're hearing that from motor carriers that want to expand into it. How do we avoid overcorrecting, Aaron?
Well, the answer is we probably won't, because human nature, it always repeats itself in cyclical businesses. And like I said, 2021 was the party, right, where the government flooded it with stimulus. This is a very different thing. Obviously, as you and many people are saying, this is supply driven. What we're seeing, though, is you're not seeing the rate of new carrier formation that you saw in those days, where anyone with a truck that could fog a mirror, could get through a school, could get licensed for less than $100. where we're seeing the strength, especially, is in the midsize, and larger fleets. For us, between 100 to 1,000 power units, where they have all of the programs in place to help give them the confidence, and frankly, give the brokers and the shippers who use them the confidence that they're prepared for a post-Montgomery world. So the break this time is, of course, regulation. And I would say the threat of litigation, which you all were just talking about, and regulation, those are always inflationary, but they're also a natural break on the process of new carrier formations. And of course, that's what got us into this very long down cycle that we began in 2021 and lasted until recently. So those should be helpful forces in prolonging this time of where carriers are actually able to earn their cost of capital, which is a wonderful thing.
Yeah, it's so important. I mean, the large fleets haven't been able to grow. In fact, you look at the data, that many of them as a class have shrunk. They haven't been adding trucks. Now, maybe they have grown by acquisition. Knight-Swift's purchasing of U.S. Express for my family is one example of a company that was pretty acquisitive over the last couple of years and was able to consolidate the market. But in terms of organic growth, it just hasn't existed. And I do worry, I think you point out a really important fact, is that endless supply of truck drivers, which has always been the capacity constraint, not the number of trucks, is that gateway is at least slowed down. There's more friction, but this industry always finds a way to oversupply itself when we least want it. And that's the part that worries me the most. I've got to ask, Aaron, there was a report this weekend, C.H. Robinson is starting to really be far more selective. Apparently, they've eliminated some motor carriers that didn't meet their safety requirements. I would suspect that this is going to happen, particularly the largest brokers are going to be doing similar things. Are you hearing that from any of your customers, or is there a conversation taking place in terms of more awareness and underwriting?
Sure. I mean, I think all of our customers are now back to the true art and science of logistics, rather than just jamming freight through with whoever's available at the lowest cost, which I'm not saying that universally happened, but undoubtedly that happened because we were incentivized to do so. So shippers are far more involved in more conversations with the large brokers and who we talk to frequently. They're, of course, more thoughtful because it's now not just about availability of carrier hiring, it's the defensibility of carrier hiring, which is what you were talking about. Because in any state law, tort claim, you're going to have to defend how you chose to do things. And you think about just that for the industry overall, it's going to be a hard fact for a shipper who's inevitably going to get dragged into some of this litigation, inevitably. Whether they prevail or not is an open question in any given case, but they will get dragged into it. But it's going to be hard to say, you can just imagine the plaintiff saying, well, you chose to save 5 cents to 10 cents a mile to use a small carrier and a small broker who didn't have the compliance programs. And as a result of that decision, you widened the zone of risk. And so those conversations are happening in this fog of war. All of us were a little surprised by this decision, exactly the way it came down. And I think that we're all in the process of recalibrating, but it's a very interesting time to recalibrate your routing guides and how you're doing things because the supply is so brittle, right? I mean, you've got litigation risk placed on top of regulation, which is being enforced for the first time in many, many years. And so people are, there's a lot of conversations going on and I imagine will continue to go on before the market sorts all this out.
Yeah, I think there's two parts of that. There's the legal risk, and then there's also the monetary risk, right? Of even if in court, the shipper is not necessarily legally responsible in this case in Texas, there's certainly a risk of monetary exposure as well, and where pockets go once the legal continues to happen. If there are
you're talking about from just a litigation standpoint?
Yeah, from a litigation
that's expensive.
standpoint,
Anyone
and a
who's
cost
been
standpoint, and a
there's a reason I got out of one of the reasons I got out of the practice of law was a case I was assigned to where an ER doctor was sued. The hospital was sued, the nurse was sued, and the ER doctor was sued. And he said, when I came in, the patient was dead. When I left, the patient was alive. Why am I being sued? Well, because he was in the chain of risk, and he ultimately was non-suited, but that was only after his insurance company fronted 6 figures worth of defense fees. And I mean, that's the reality we're going to be dealing with. You can be right, but it's going to still be very expensive to be right. And that's all got to get priced in.
Yes, I agree. And so we talk about all of this, and all of it does lead to higher costs. And we think about, you mentioned the sort of gap between the small carrier and the larger carriers and this compliance gap. When we think about those smaller carriers, what is Triumph doing about fraud and prevention in that part of the market?
Yeah, so we deal with carriers in 2 ways, right? The first way, and I think what often gets talked about, the payments network, our job is to make sure we pay the carrier or the carrier's factor on time, the correct amount as instructed by our client. And when we do that, we of course try to provide them information if we're seeing financial risks of fraud. We're not, there are other people who are deeply involved in compliance and insurance and things that are going on load. Our visibility window is definitely into the financial risks, which oftentimes overlap with operational risks. So that's one way, and we're still seeing small carriers be used. And then secondly, in our factoring business, where we're not just paying them, we're actually a financial partner. A lot of our carriers, I think, are doing well, partially because to onboard with us, since we are a bank, they had to go through a level of compliance that you don't always have to go through with other non-bank financial companies. So right now, we haven't seen an exodus of small carriers. They're still getting freight tendered to them. But what we haven't seen is just a bunch of new carriers come into the marketplace. It's kind of like we're just stuck.
But Aaron, isn't that maybe not as good for a business that wants small carriers from a factoring standpoint, but from a market oversupplied standpoint, you're telling us what I'm hearing is that we're not seeing an increase substantially that's driving this market potentially to an overcorrection, which I think is the biggest risk right now. I mean, Julie, what you talked about, LMI being at record highs, never recorded. It's a very reputable index, very reputable survey. We follow that data. It follows our data quite well. It's interesting because there are the conditions for oversupply, except you don't have the driver availability. And Aaron, you're not seeing smaller carriers enter the market to the degree that you were. It sounds like that's probably your biggest prognosis, is that this cycle, I've called it before, could become a trucking super cycle. And as you mentioned, it's not just Supreme Court. It's the states, it's the federal. Everybody seems to be acting in spirit to really create more regulation of whom can become a trucking company and a driver.
Yeah, the fact of the matter is the drivers who have left, or the drivers who drove the most at the cheapest rates. Right? So you have removed that segment of capacity, and that's a generalization, but it's generally true. And this feels much more structural than cyclical. If we are going to continue the regulatory posture we currently have, and I would say, people could say, well, you could have a change in Washington. I'm not so sure that this is a Democrat versus Republican issue. This is a protect our supply chain and protect our roadways issues that both parties can get behind. And even if that were to change, we go back to what we were just talking about, the fear of litigation. Your compliance standards are so much higher for carriers. So we created a barrier to entry that probably means the supply side of the equation will not react as quickly as it has in prior cycles, which could lead to a very long and strong cycle of freight pricing moving upwards.
Yeah, it's interesting you say that. We had Derek Bars in studio a couple weeks ago. He's the FMCSA administrator. And we talked about that. Is this going to be a situation where we're going to see a different administration comes in? He talked about it. He's like, look, I want to set the standards that regardless of who's in office, regardless of which party's in office, these set of standards, this regulation will stay in place. And I think that's what the FMCSA and the DOT are trying to do. Delilah's Law is a part of that. Delilah's Law If it passes, we got to get through Congress. Things they don't seem to be passing much these days. If we can get that passed through Congress, that codifies it in the law. I mean, you as a lawyer, you know how important that is.
For sure.
Former lawyer, a recovering lawyer. He went from lawyer to banker.
A recovering lawyer. But yeah, anything. Why have regulations if you're not going to enforce them? Yeah. That makes no sense. And so if we have regulations that we believe make us safe and we do enforce them, that's a supply constraint. And ultimately, free markets will figure it out. And I mean, right now, I think truck drivers in Chicago are making 70 cents a mile. Well, if you're driving 3,500 miles a week, that's a six-figure job. It hasn't been that way for the last few years. And if you can offer that kind of job, you're going to attract or those kind of wages. And one of the things I hope, and I think some carriers are working on, is turn this into a career, not just a job. You're going to attract people who can, that I think are going to be safer for the roadways and are trained and, understand traffic signals and all of those things. And so the market is sorting this out, but it's not, you're not just going to be able to jam a bunch of capacity in here because of the legal risk of doing so and because of the regulatory risk of doing so. And that is definitely a change.
Yeah, Aaron, it's interesting you say that because I always follow the money, particularly when it comes to Congress. That's what matters. The larger carriers, as part of the ATA, have been the one for many years wanting to lower the barriers to entry with the thought that they would end up with these truck drivers. What they didn't anticipate, they now know, is that lowering the barriers to entry does not necessarily help them, it actually hurts them. And I say follow the money because as long as the environment that we're in, and I talk to a lot of the executives, many of them are afraid to sort of go on record, but they will talk behind the scenes about, frankly, how pleased they are with the compliance crackdown, how pleased they are with basically shutting off that gateway of truck drivers that were unregulated, underqualified. This narrative about the driver shortage, I think, did an enormous amount of damage because that really encouraged a lot of deregulation. I think those days are over with. I can't imagine, regardless of administration, when you have the largest, most well-funded participants, including freight brokers, people think, and I know, Aaron, you've got many more freight brokers that you talk to because you guys are just all ubiquitous in this industry. I think many of the largest freight brokers have actually said, we want more compliance. We want more compliance. We want more enforcement because we realize with more enforcement, that means there's less risk for us and the market starts to act more rationally. I mean, what are you hearing from your folks? Your customers?
No, that would be very true. And of course, Craig, as you know, I think that's the narrative you hear from the C-suite of freight brokers who take the long view of, we want qualified capacity. Like, we don't want to be tendering freight into a marketplace where we're worried about all of the things that have made a lot of headlines, from theft, fraud, unsafe driving. And so the marketplace generally wants that. Now, people on the floor who, their commission schedule, I mean, they're always under pressure. Look, this is my rate with my shipper. I need to go cover this load and make a margin. And that's a very real and an understandable pressure. And so that's where the tension is between wanting compliant carriers, but also needing to make a margin. And so I think we're all better off. We're all better off. People driving on the roadways, brokers, carriers, we're all better off if we create a pathway for trucking, these trucks to be managed and operated by people who are adequately trained and adequately paid. I think that's fair for the driver. I think it's fair for the industry. And I think it's better for us as a society because freight is such a large part of what we do. And it's very difficult to allocate capital in a marketplace where you're not sure if your competitors are playing by the same set of rules you are. And so getting a common set of rules so the best service providers can win and win fairly is going to be good for all of us.
Aaron, I got to ask before we go, what is next for Triumph? You guys have done some big transactions, big acquisitions over the last couple of years. What is next? What can we expect next from Triumph?
Yeah, I think you'll see us stick to the value chain that we're currently in. We audit invoices, we pay invoices, we provide intelligence back to our customers, like you all do. And then, I mean, our brand promise, we think about it sort of two ways. Number one, We want the industry to be able to transact confidently. And that's not just us, that requires other people. And that means knowing that if I take the freight, I'm going to get paid. And if I am hiring someone to haul the freight for me, I know who to pay. And so anything attendant to that will do. And then ultimately every trucker thrives. Like I don't want, and I don't think it's healthy for the industry and for the demise of the small carrier. That's not the right answer. What we want is the small carrier to have a healthy business model that is sustainable. And so what we want is every trucker to thrive. And so we're trying to help these carriers with financing their trucks, which is obviously more expensive. We're trying to help them with insurance, which is going parabolic. We're trying to help them save money on fuel, which is way above where it was. You know, if you add all these input costs in and you go back to my reference earlier about the rates in 2021 versus the rates now, the margin left over to the carrier is not as high as it was in 2021 because even though the nominal dollars are larger, the input costs have gone up. And so we're just trying to help small entrepreneurs run their business and lower their cost, get the equipment they need. And that's what we're focused on for the rest of this year and beyond.
Yeah, my friends on FreightX, the drivers, always point that out when I talk about how strong the market is. They always have to humble me and remind me, but their operating costs have gone way up and they're not making as much money as they did. So it's a point of sobering. By the way, Aaron, congratulations. Your stock has been on a run. You can find it as TFIN, TFIN. And Aaron, really appreciate it. I hope to have you back. Maybe we should come on site to Texas. I've got to come down and visit my son when he goes back to school.
I'm there for it.
Let's do it.
Thanks, Aaron. Appreciate it. Have a great day.
All right, next we're going to take a quick break, but stay with us because coming up, we're going to do a deep dive into the sonar data and see what's happening with capacity.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
Well, Julie, that was an amazing conversation with Aaron. Look, he's always a source of information. You know, they have the factory business, they have the payments business. They're a bank. They sort of see it. I mean, ultimately this business is all about money and the movement of money. Not they move money, we move. Other people move freight.
Right.
They happen to help do both. What'd you think?
I thought it was great. I loved hearing some of the things about the data that he brought up and what's happening in the market and the invoice costs and the point that I thought was incredibly interesting was smaller carriers are hanging in, but they're not seeing any new entrants. And you kind of keyed in on that and hoping that there will not be overcorrection in our market like we always tend to do. And I think that creates a lot of hope for a self-correcting market, but in a healthier way than what we've seen in the past. Yeah.
A super cycle that may go on for many, many months, many, many years potentially. I talked about this morning. I actually talked about what we're seeing in the market, and I do a morning video every morning to talk about market, and
we're going to get right to it. So
yeah.
We're going to go deep into the data with Craig's Sonar Morning Update.
Capacity is continuing to tighten. Truckload rejection hit their cycle high, 16.36%. It's a pretty significant tightening cycle that's been going on for really since last fall. But these are levels that we have not seen on the Sonar Truckload Rejection Index, STRI, for those that have Sonar access. And what we're seeing is super tight capacity. Anyone that thought capacity was going to loosen coming out off of Road Check Week or out of Memorial Day weekend is sorely disappointed because capacity is not loosening. And it's showing up in the spot rate data. We hit an all-time record yesterday on the daily rate of 383 a mile. That is an incredibly high rate in levels that we haven't seen, a reflection of just how tight and how, frankly, expensive it is to find trucks right now. If you are a shipper, you are likely struggling to maintain your routing guide, and you're probably seeing at least one, if not more, multiple rate increases that are being asked among your carrier and provider base, and that's probably going to continue. There's no signs that the compliance crackdown is going to slow down anytime soon. There's so many factors, whether it's the SCOTUS-Montgomery decision and the reprioritization of capacity. C.H. Robinson, as we reported on FreightWaves, there's been conversations and reports about the fact that C.H. Robinson is calling some of its capacity, trying to prioritize its carrier base. Again, it looks like they're using safety scores, the CSA score, to really make those decisions, but there may be some other factors in C.H. Robinson's underwriting. And with it being the largest freight broker in the market, I think it tells us a lot about the direction of really all the participants, all the major 3PLs over the next couple months will continue to look at those underwriting criteria and decide who they want to do business with. That is going to continue. I don't see anything slowing that down. We also are looking at incredibly strong tightening in markets in the Midwest. Shelley Simpson talked about this yesterday on FreightWaves Today. Just if you are a truck driver in Ohio or really in the old Rust Belt, good on you, because you've got all sorts of opportunities. It's very hard to find truck drivers right now in that portion of the country due to a lot of the compliance crackdown that's been taking place. What we're all looking at is, where does this go? June is the busiest month of the year, so the fact that we are at these levels is not surprising to anyone. We talked about the fact that coming into June, we would be significant increases in volumes. There always is. It is the busiest time of the year, frankly, because the types of freight that move throughout the calendar seem to overlap all in the month of June. You get produce season that's really cooking. You get a gardening season. You get construction that's really strong. You get back to school that's really starting to pump across the market. Beverages are really, really strong this time of year. You just have so many things that are influencing the freight market in June in terms of demand. And that really drives a lot of the elements. And so the idea that this would somehow cool off in the month of June just is something that, I never bought in, and been talking about the fact that we don't expect it to cool anytime soon. And it looks like this is going to take us through the rest of the summer. I think the question is what happens in the second half of the year. And as we move towards peak, are we going to see tighter and tighter conditions? And I would contend that we'll probably see a little bit of softness maybe in late August. But as we enter peak season at the end of the year, things are going to look incredibly tight from where we sit right now. There's no reason to think that the compliance crackdown is going to slow down anytime soon. Again, this is driven by so many different factors. It's additional liability issues that brokers are having to contend with under Montgomery. It is the federal government and what they're doing around licensing, what they've done around modus. That in itself is a pretty significant impact. The states themselves are taking on their own level of compliance crackdown, starting to really enforce a lot of the rules that are on the books and look strongly at CDL underwriting and whom can get a CDL and who has a CDL. And we've seen states actually move drivers that had a CDL off of, basically they lost their permits to drive. And that we saw that in Indiana with 2,000 truck drivers losing their CDL. So this is going to continue across the country. There's no reason to think the capacity is going to come back anytime soon. Capacity underwriting is getting tighter. And now you have a labor issue or labor availability issue that's going to also pop up. As we're seeing data center build out, which is a big driver of freight demand, and potentially construction coming back, there's some elements in the market that suggest that housing could be coming back. We're hearing reports and seeing things that are sort of signs the housing market is starting to show some signs of life. All of that is going to drive more labor out of the trucking market, and that's going to create tighter and tighter capacity. And that will take us through the rest of the year. And so we're going to see additional volume potentially coming into the market with sort of stronger economic indicators in addition to tighter labor. One thing I think was really interesting yesterday, we hosted our inaugural episode of FreightWaves Today, which is our daily streaming show called the Squawk Box of Trucking or Squawk Box of Logistics. And we had three very prominent CEOs and executive leadership that were on that call. We had the Port of LA director, we had the CEO of JB Hunt, we had the president of Estes. And what we heard consistently was that volumes were stronger than they anticipated. As we heard in terms of imports in the Port of LA, retail consumer volumes have not been sapped by higher gasoline prices or higher energy prices, and it's frankly a little surprising to the Port of LA executive director, Gene Soroka, as well as with Estes, the largest privately held transportation company and one of the largest LTO companies in the entire country. They have been really surprised about how robust the consumer has held up, particularly in retail freight. And I think that's a really important sign because we've all talked about how strong industrials are and factories are right now with the benefit of AI data centers, energy and defense production, and really global industrial competitiveness really is a reflection on this as well as our energy prices are cheaper here, therefore it's cheaper to make products in the United States than perhaps other parts of the world, and therefore our products become more competitive on a global stage. All of that is a backdrop on how we're seeing in terms of industrial activity, but the question has been, what is happening around the consumer? And as we heard yesterday, there's no signs that the consumer is slowing down, and that's really a bullish sign for freight markets because I think that's been a question that a lot of people have been asking. Will the consumer impact the freight market this year, particularly with higher gas prices? Doesn't appear to be the case. And in fact, we're getting a lot of really strong signals. So all of this is really a reflection that if you're a shipper, you need to prepare for incredibly tight conditions as we head into the second half. You should be looking at your routing guide and make sure that the partners that you've got feel comfortable with the rates that they've offered, feel comfortable providing you capacity, and ensure that they are compliant with their obligations. If you're a motor carrier, this is your opportunity. You haven't had one in many, many years to ensure that you get properly paid for your capacity. Have those conversations with your shippers to just tell them, hey, we're going to have to raise driver pay. We've got a lot of headwinds on our own in order to attract drivers. We're going to need higher rates. This is the time you get it. If you're a broker, of course, you're going to end up with a lot of spot opportunities across the market, but also you're going to be dealing with pressure in your contact rate. So this is going to continue. There's no reason to think this is slowing down anytime soon, and we'll keep you updated here at FreightWaves Today, as well on all aspects of FreightWaves network and data services.
So I record those segments every single morning where I look at the data and talk about what's happening. We're now going to incorporate that into FreightWaves Today, where those morning market updates are incorporated in the show, so you can tune in every single day. We're going to hold off publishing them on social media until the FreightWaves Today segment goes live, but tune in every single day. We have a brand new segment called Capacity Now by RXO, which is all about what happens if you're a shipper and routing guides break down and you don't have capacity. You need to call the 911 operator, the emergency ambulance to get you out of trouble when no one else has a truck. RXO is there for you. This segment, Capacity Now, is all about that. And let's dive into really what's happening, because it's exactly what shippers are feeling right now. Is the routing guides are breaking. We've been talking about that frequently at FreightWaves, how routing guides just are not well positioned. Spot rates are shooting up. Carriers are being far more selective, and we can see it right in the data. As we talked about earlier, the Sonar Truckload Rejection Index is at an all-cycle high. We haven't seen these levels since 2022, 16.36%. A real sign that capacity is tightening. And I think what's interesting, as I pointed out in the video this morning, is the fact that tightening is happening even more so than Road Check Week and Memorial Day weekend. And I think this is going to continue all the way through the rest of the summer. There's no reason to think that things are cooling off. And there's going to be those late afternoon loads where you are in trouble if you're a shipper and you don't have options. RXO is here to help you. Julie, let's talk specifically about what you've been in the front lines. You've dealt with these last minute situations. When shippers run out of options, what do they do?
You have to have a backup. You have to have someone to call. There will always be those last minute loads, projects, surges in capacity that your regular carriers cannot handle, right? That they just cannot get to. They've pre-committed their capacity to someone else. The market gets tighter. Another customer surges. Having someone to call at the last minute is incredibly important, who you know will actually pick up that freight and make it their top priority. Sometimes you have to pay for that. And in a market like this, you might have to, and it's worth it if service is your top priority.
It's 911. It is, I have to get this load covered right now. And I need someone who's going to be my emergency backstop. And RXO has positioned themselves to be that. Let's talk about the types of situations. Right now, rejection levels are at highs that we haven't seen in many years.
1 in 5 loads are getting rejected, right?
It's an amazing stat when you think about the fact that just a couple of years ago, we were like 2.5%. Drew Wilkerson, the CEO of RXO, has talked frequently about how tender rejections drive an important part of their business, those spot opportunities, because they're the ones that when everything else is breaking down, you call them up, you say, hey, I need a truck. Because if you don't do that, your freight's getting left behind. Why are trucking companies rejecting at the levels they're doing right now?
Well, they only have so much capacity available, right? And they also have really great spot opportunities in the market currently. So if you are committed to a customer and you have to take 5 loads a week, but you're really not going to get dinged if you take 4 loads that week instead of 5 at your contracted rate, and you can save that 5th truck and make a significantly higher rate on that truck in the spot market, you're going to do that and you're going to play that game. Tender acceptance is such an important part right now of running a profitable trucking company and taking advantage of this upcycle after coming out of 4 years of a down cycle.
Yeah, they have, we have talked about carriers' revenge. The fact that trucking companies have lived in this environment where many of them have not been making money. Their balance sheets are really, really challenged right now. They're trying to get back to a point of profitability. Perhaps they are, some of the big companies, big truckload carriers did not make profit in the first quarter despite market conditions. They are coming out of that. They're well positioned. They have pricing power. They're certainly flexing it. That is causing pressure, and that's where we're seeing it in the rejection levels where they're just increasing. Are you surprised that rejection levels are higher today than they were coming out of road check week or even Memorial Day weekend, or did you expect this?
I expected road check week to be the highest, but no, I'm not surprised. We're getting into a new month right now. I imagine there was a little bit of lag the last week of May with the holiday and drivers coming out of the house. They're back and they're available, but we're seeing demand pick up a bit. And I think that also carriers are going to continue to think about their balance between spot and contract. If large carriers usually try to keep about 85% of their capacity committed and play that other 15 in the spot, they're going to push that as far as they can without angering their customers right now to take advantage of that higher spot capacity that they can get from brokers or that they can grab from transactional opportunities.
And there's also, and I know you've seen this, where large shippers, these really important customers, are going to expect a carrier, particularly if you're a large carrier for them and they're a large customer to you, they're going to expect you to take more freight from other carriers that are dropping off, which means that you got to then look at your customer base and say, maybe these shippers who haven't been paying me as much, or maybe this freight, this is a much smaller customer. Unfortunately, you kind of get dropped in the grease in this moment in time. Yeah. You got to have a backstop, right? It's all about those emergency opportunities, which frankly, having a 911 operator, having an ambulance to get you out of trouble is more important in this environment than it's been for many years.
Yeah, this is an environment where carriers can scorecard their shippers for once, rather than shippers only scorecarding carriers, right? And so some shippers are going to get left behind without capacity available for them.
Yeah, it does happen. That's why rejection rates. Let's go and look at the map of where this is actually taking place, because I think this is really interesting. I've talked about this frequently. Where is it taking place? And, we had the opportunity yesterday to visit with Shelley. I also thought the Estes conversation was about the fact that retail is holding up. And I talked about that a few minutes ago in the video, is that the concern has been around consumers, higher gas prices, consumers feel exhausted, at least. You look at the survey data, they look like they're exhausted. That's not what we're seeing in the freight markets. Is consumer retail business is quite robust relative to where expectations. Gene Soroka also said it at the port. So imports levels are, particularly LA, are doing well. But I want to talk about the Midwest. Shelley talked about this yesterday, where in the Midwest of the country, the central part of the country, is where it's harder and harder to find capacity. Now, she equated that as much to driver availability as anything. But it's also, I think, some of this reindustrialization, AI data centers, defense, energy. The old Rust Belt is performing. And you see rejection levels are extremely high along this. Have you seen a map like this? Do you remember it being this tight?
I do. During COVID and other times. Maybe not across and not in the Midwest, certainly. But I think that, exactly to your point, the Midwest is a manufacturing hub, and the new LMI report came out for May yesterday or today, and it said exactly that. Manufacturing and warehousing are incredibly tight and doing really well, expecting retail to quickly follow, which we heard yesterday, and waiting for the rest to continue to recover. So the Midwest being incredibly tight, parts of the Southeast where manufacturing is occurring. To your point, AI data centers, things coming out that require, large infrastructure types of commodities are going to continue to get tight. I don't see this changing, though, in the near future. I think it's going to stay tight.
Yeah, look.
In the Midwest. And I think the ports will continue to pick up.
June, as I pointed out, is the busiest shipping month of the year. You see that in the volume data. You also have tightening capacity. There's no reason to think that capacity is going to suddenly show up. There's so many pressures. You have SCOTUS, which is taking C.H. Robinson, being tighter screening. Other brokers are going to do the same thing. That's going to leave some carriers out of opportunities. It's going to make it tighter for those carriers that have high quality safety ratings, are just going to have more opportunities available to them. Shippers are starting to put more pressure on brokers of whom they're doing business with and who is compliant. Governments, not only the federal and the states, they're cracking down. But again, I think the most interesting story in freight right now is the Midwest, the rise of the Rust Belt, the rise of U.S. manufacturing. Yes, it is AI data centers. And yes, it is defense spending. And yes, it is energy and power. It's all of that. and it's happening right here in the country, and this is the most exciting time in freight. This market's going to continue to cook. Joey, thank you so much. We're going to get right back to it right after this.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
The map is changing. As global uncertainties rise, the future of the supply chain is moving closer to home. Welcome to the new coast-to-coast North American network. Driven by massive reshoring trends and next-gen industrial innovation, optimized by AI workflows that build unshakable operational resilience, and locked down by proactive security against evolving freight fraud. Are you ready to navigate the shift? Join the industry's top minds to build the future. The FreightWaves Domestic Supply Chain Summit. Streaming live June 17th. Register for free at live.freightwaves.com.
Welcome back. I'm thrilled to introduce our second guest of today, Jeff Ackerman, the CEO of STG Logistics, after they're emerging from Chapter 11 and shedding over $1 billion of debt. He's here to talk to us a little bit about what's happening at STG. Craig?
Jeff, story company. STG is a company, the name itself, for those that have been veterans, that have been in freight for a while, may not be as the name relatively new, but it's the old Pacer is part of that XPO, the intermodal business. Tell us a little bit about who STG is for those that aren't as familiar with the business.
Yeah, so STG Logistics is a port-to-door containerized logistics provider. So if you think about that old Pacer international business, which was really one of the pioneers of the asset-light, kind of IMC operating model back in the 80s and into the 90s. We sort of bought that business, which had been acquired by XPO back in like 2014, and combined it with STG Logistics facility-based logistics services. So think about now having the ability to provide a port dray to a facility, leverage our facility-based logistics services to deconsolidate the freight that's in that international container and then reconsolidate it into a domestic intermodal container or sometimes into an over-the-road trailer to get it to its ultimate destination, whether that's a customer location, whether that's a place they tell us to send it, one of their customers. And so we really have that full soup to nuts kind of end-to-end containerized logistics capability that we think is a unique, kind of supply chain solution for customers, particularly in markets where, like now, where volatility is a little bit more pronounced.
Yeah, talk about timing of coming out of restructuring. You guys restructured, came out, you've emerged out of it.
Right.
You're in an incredible position with a nice balance sheet, putting you in a great position to enjoy. It got to be the greatest freight market, at least since COVID. I would argue this might be better because it might go on a lot longer. What are your thoughts?
Yeah, no, you're 100% right. I mean, so we're coming out of this with a very clean balance sheet, coming into a market that is we expect to be improving greatly with a ton of financial flexibility. And that puts us in a position where we can really invest in our people, really invest in our service, really invest in our technology, really invest in our capabilities, and be in a position where ultimately our performance and our ability to execute for our customers is going to help us drive the next phase of growth.
What is in your modal in terms of percent of revenue? How much of it's international driven? Sort of international import markets. We had Gene Soroka, the port director of Los Angeles yesterday, talked about the fact that I think this was the second biggest April on record. He seemed pretty, I would say, constructive about the state of the consumer and state of the import market. In your business, how much of it is domestic versus international?
Yeah, think about it as kind of 70-30 domestic, international in terms of just drawing that like rough delineation between the two. Obviously, a lot of what we handle in this country domestically does start in some form or fashion from somewhere overseas, right? So if you think about domestic intermodal freight, there is a portion of that is originating overseas, right? We're transloading at a ocean port market of origin, and then moving it inland from there. But roughly speaking, call it 70-30 is kind of domestic versus international.
And are you seeing anything different in the sort of the mix right now? Is domestic doing better than the international freight is, or how are you thinking about the market?
Yeah. So I would say, broadly speaking, I think we're generally a little bit more optimistic, I would say, about the domestic market, right? Obviously, folks at FreightWaves, yourself included, have been calling out, how the market does seem to be inflecting here, particularly early in the year and into the second quarter, as it relates to the domestic market and sort of what's happened with capacity as a result of regulatory actions and further compliance driving sort of capacity out of that market. So we're more, I would say, bullish on that market going forward. I think the international market is still a little bit of a mixed bag, candidly, right? So you have a lot of volatility in that market as it relates to sort of the things that have happened in 2025 as it relates to tariff policy, how that's driven sort of demand pull forward, and how what does that mean for 2026 and 2027? A little harder to kind of call, I would say. But we're still, sort of optimistic about where STG is positioned, particularly given our sort of balance sheet and our financial flexibility going forward and the diversity and breadth of our capabilities.
Now, when did you join the organization?
So I've been in with the organization for roughly 10 years.
Okay.
So I started in early 2017 and began my role at STG as CFO. Ultimately moved into the chief operating officer role and then ultimately became president and then CEO in April of 2025.
So no one should know the numbers better than you. That's coming through the restructuring process.
Yep.
I imagine that was everybody who's been through any kind of restructuring talks about just how frustrating it is. It's a long process. Anytime you got courts involved, you got creditors involved. What was that like going from the CFO role, just for you personally? I imagine it was a big drain, or was it? Did you find was it an interesting project?
Yeah, I wouldn't describe it as a drain at all. So look, restructurings. Obviously, there's some complexity that entails. There's obviously some sort of non-ordinary course type activity that entails. But in terms of sort of how that experience was for me, I mean, we've got tremendous customers. We've got tremendous vendor partners. We've got tremendous team members at STG. And ultimately, having that kind of makes the job easy for someone like me, right? And my role really through this process is just to communicate transparently with whatever stakeholder it is that I'm engaged with, be proactive in that communication, be realistic but obviously optimistic, and ultimately, we came out the other side a lot stronger than we went in.
Now, how would you describe it? I've worked with great CFOs who then become operators. They're always leading through the numbers because that is the training, that is your background. Is that how you think of is your role as CEO really to define a metric-driven organization, unit economics? Like, how are you positioning the organization perhaps different than it has been?
Yeah, that's a great question. So it would be disingenuous for me to say that I don't think about the numbers, right? That would be
You wouldn't be a very good CFO, and I imagine as long as you've been there, you would be.
Yeah, that would be very disingenuous of me. But I think the having the CFO background certainly allows you to sort of understand and analyze the business and understand where value is created in the business, understand sort of how unit economics, like to use your words, how things sort of flow through the P&L, through the balance sheet, all important things to understand. But at the same time, it also just creates some discipline around, where are we going to focus, right? And for us, the go-forward focus is around really about being a great service partner for our customers, being a great partner to our vendors, making sure that we're focused on executing consistently across the business, being that reliable partner, and certainly making sure that we're spending our time on the things where we can really bring sort of outsized value to our customers, to our partners, because that's ultimately where we're going to sort of be most successful.
The most that I ever was exposed to intermodal in terms of operating was when U.S. Xpress had a TOFC business, which I'm not even sure is much around anymore. The railroads have de-emphasized that. Yep. Obviously, the stack trains are far more important today. What does the metrics look like when you're thinking about the performance of an intermodal IMC operator? What is it that when you're looking at in the trucking business, this revenue per truck per week, how do you guys think about utilization, and what's the metrics that really drive your business?
Yeah, I mean, so big picture, and when you're thinking about utilization, just to start there, because that's where you brought it, you're really thinking about sort of loads per container per month, so how much you're turning the containers. Yep, exactly.
And I imagine it's load, correct, not just empties.
Yeah, loaded, exactly. So loaded moves per container per month is a typical metric that we sort of focus on to make sure we sort of utilizing our assets in a way that sort of makes sense. But then obviously, set aside sort of asset utilization. I mean, in this market where we're working to sort of convert freight from highway to rail, services is so critical, right? So we look at on-time pickup, we look at on-time delivery, we look at sort of trip plan compliance. So did we sort of commit to do what we committed to from a service perspective in terms of transit times? Those are sort of critical right now. They always are critical, but certainly critical for us right now and going forward.
And one thing I've noticed in our data, because we track intermodal door-to-door pricing, we obviously track truck door-to-door pricing, which is really the definition of trucking.
Yep.
I've noticed that really over the last couple of years, the railroads, particularly last year, as trucking spot rates were heating and contract rates were going up, it almost felt like the railroads were not increasing the rates to the degree that the trucking market is. Is that a market construct in terms of they weren't aware of what was happening in the market? Did they have excess capacity? Why were the intermodal operators, why did the railroads take a while to increase rates?
Yeah, so big picture, for the most part, railroads rely on IMCs like STG to sell the intermodal service, right? Provide that door-to-door service. So if you think about intermodal generally, we are providing a true door-to-door service, right? So we provide a truck move on each end of a rail move, and then we obviously bring the container capacity to the party as well. We have 15,000 STG branded intermodal containers that we use here domestically. So that's one thing you got to keep in mind is generally speaking, with some exceptions, the railroads are not necessarily selling directly to retail customers, right? In terms of shippers, selling direct to shippers. The other thing is intermodal is largely a contract-driven business. There is a spot market for intermodal, but generally speaking, compared to truck, it's much smaller, right? Obviously, when you talk about what's going on in the truckload market, there's obviously contract rates, there's spot rates, what's happening with spot rates and contract rates, and kind of how that flows through routing guides on the contract side. That's all highly relevant. Less relevant in intermodal. It's primarily a contract business. Generally speaking, the inflection that you're seeing in the truck market and how that reads through to intermodal is going to lag because you need contracts to roll over, and you need to obviously have appropriate partner-like discussions with your shippers around what do rates need to look like going forward.
And imagine, JB Hunt, Hub, you guys, we're just taking share. It gives you the opportunity to provide a lower cost product in an inflationary market against truck. Is that how you're thinking about the market now? Is this a market share game? I mean, I always know that when fuel goes up, the intermodal fuel surcharge is a massive arbitrage for shippers,
right?
A savings arbitrage.
Right. Yeah. So I think we view intermodal in the long term as a mode that should grow relative to truckload, right? And the reason we think that is big picture, lower cost over time. Fuel, what's going on with fuel right now, certainly a tailwind for intermodal demand, but just generally speaking, intermodal should be a discount of roughly 20%, give or take a bit depending on the lane, to truckload. Obviously, you also have the benefits of decarbonization and sort of the benefits that intermodal brings relative to truckload in that regard. Lower emissions by a significant amount, right? So I think coming into this next cycle, I think it's really going to be focused on, intermodal is really going to be focused on, conveying the benefits that intermodal brings to truckload. Obviously, we have a fantastic service product to sell now because our railroad partners, all the class ones, are really delivering from a service perspective at a high level. We also have some of the challenges that maybe occurred during the course of COVID around equipment availability. Those have primarily been resolved, and so I think shippers can be confident about that going forward. So I think we're going to be thinking about it as we need to obviously price things appropriately to deliver to recognize the value and the service we provide. But it's really going to be about further educating customers and shippers around the benefits that intermodal can bring to their supply chains, both from an efficiency perspective, a cost perspective, a reliability perspective, and an emissions and environmental efficiency perspective.
Yeah, I mean, Warren Buffett agrees with you that railroads, when he bought BNSF a decade ago, there was a lot of conversations. In those days, it was interesting. It was a conversation about automated trucks could take away share from railroads. Warren Buffett rarely gets it wrong. He has been right. It's been one of the most, I think at one point, I haven't looked at the numbers lately, but it was like 40% of the entire market cap was tied to BNSF's value. What an amazing story. The railroads are interesting. We're obviously big friends of Trains here. We own Trains Magazine. The big conversation this year is about transcontinental rail freight. How are you guys thinking about the mergers and alliances and what's happening with intermodal? Is this a bullish thing for you? Does it create concerns?
Yeah, I mean, look, I think there's a reason why those two railroads have decided to try and sort of get married, right? Obviously, they're excited about what a transcontinental combination could mean. First time that it's ever been here in the U.S., right? Certainly something that you can get excited about if you've been in and around trains or intermodal or railroads for the course of your career. Ultimately, for us, what we're focused on is delivering a high degree of service and reliability to our customers. And to the extent that a transcontinental railroad allows us to do that and sort of benefits all of us IMCs in terms of our ability to sort of provide a competitive service product, then it makes sense.
It strikes me that intermodal's in a better position to win on a transcontinental railroad. I think that's what the railroads have said, more so than perhaps some of the bulk freight. We're going to see, I mean, there's been this STB application process, which I believe, if I'm not mistaken, has been accepted with some commentary. I know that you're not privy to what's going on at the STB. We actually have the SPV chair coming to an event that we are hosting in July. He says he can't talk about the specific question about mergers, but just getting the take on how everyone in the market's thinking about it. You also have a big container freight station, a CFS. And for those that aren't familiar with the term CFS, this is basically an import. In fact, I've been in freight my whole life. And my brief time in air freight, we had container freight stations. I had to do the fingerprints to the government, had to make sure I wasn't a criminal. And that was the last time I heard about container freight stations until last year.
Okay.
Everybody cared about container freight stations. What does that business look like for you guys? I mean, tariffs, there's been a lot of noise, a lot of backlash, or sort of changes. What does it look like from your standpoint?
Yeah, so the CFS business is an interesting one, to your point, right? So just to educate the viewership here a little bit on what those are, right? So we have a network of facilities in the U.S., primarily around ocean ports, as well as big inland, kind of ports of entry, Atlanta, Chicago, places like that, where we run a network of customs bonded facilities, right? So what that means is freight comes into our facility and it doesn't clear customs until it actually leaves our facility, right? And so that gives us the ability to give shippers, customers, importers, the ability to sort of think through how they defer duties and manage kind of the cash flows that are related to duties as inventory moves in and out of their supply chain. And so that's been a sort of a boon for us here, I would say, in the kind of post-Liberation Day era, because we've been able to allow folks to have things like Class 3 bonded storage where they can bring things in, store them in bond in our facilities, and then obviously wait to kind of see what happens with tariff actions and the like in a way that kind of helps benefit them in terms of how they think about their inventory planning and all those things.
Well, none of us know what the president's going to decide next on tariffs or what the courts are going to influence in that. It's anybody's guess. I think for importers, knowing that there is some level to protect themselves regardless of what happens if the tariff situation is really important. Like I said, no one was talking about container freight stations outside of the people that are in your world up until last year, but it's become very popular.
That's right.
I've got to ask, what is next for STG? Like, where are you guys headed?
Yeah, so we're going to lean in on just continuing to execute for our customers, right? So you've heard me say a couple times as we've talked here, it's there's and you just kind of hit on it. It's a volatile market. Certainly, there's reasons to consistently and continuously expect the unexpected. And I think customers, shippers, they need to lean in with providers who provide consistent execution. Reliable access to capacity. I heard one of my competitors, Shelley Simpson, say yesterday, the sort of say-do mentality, do what you say what you do. And that's sort of how we're thinking about the next 12 to 24 months for STG.
Yeah, it's a really exciting time. Congratulations I asked Shelley yesterday, how did it feel that she took the job as CEO about the time of the freight recession? You have the opportunity, sort of the opposite side of that, to sort of see through STG's greatest days, perhaps.
That's right. So, yeah, I'm tremendously excited. Like I said, we've got great customers, great partners, great capabilities, great employees. So really excited for what the future holds for STG.
Jeff, really appreciate coming in to chat and day two. You're our second guest. Michael Caney walked across the street, so that doesn't count. Caney's a good friend, but he doesn't actually get credit for coming into town. You do. I really appreciate it. This is amazing. Congratulations on as you guys are repositioning the company. I can't imagine a better positioned opportunity for STG and transportation overall.
Yeah, thank you very much for having me. Appreciate it.
Thanks, Jeff.
Thank you so much, Jeff Anderman from STG Logistics. I just have to say a quick thank you to all of our partners that are on the carousel on the bottom of your screen supporting the show, with a special shout out to our friends at Samsara for making this show happen. It's National Safety Month, which means this is a great time to ask how your fleet can prevent more accidents. Samsara AI detects risk in real time, giving teams more visibility into what's happening on the road and more context to coach drivers before risky moments become incidents. Fleets using Samsara's complete AI safety solution have reduced crash rates by nearly 75%. See the data behind the results in the Samsara Safety Report at samsara.com/FreightWaves. Next, we're going to take a quick break, but we have some great things coming up on the back half of our show, including guests John Kingston to talk about all things happening with oil, and a special guest from U-Haul as well, Jeremy Donahue. We'll be right back.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Well, welcome back to FreightWaves Today. We're excited to have you back. That was an amazing conversation with Jeff. Just absolutely, totally dialed into what's happening in intermodal. And look, I can't help but think about oil and fuel and the discount of fuel when you think about intermodal. Okay. And there's no better expert than that than John Kingston. He is the smartest man in oil, and we are so fortunate to have John Kingston here at FreightWaves, covering not only the oil markets, but freight. John, by the way, I have learned so much about commodity markets from you. What, you've always told me that the incremental barrel is sets the price, and I always tell people that's true in trucking as well.
That's right. That last barrel sold or bought, whatever, it doesn't matter. That sets the price. You know, and trucking is sort of a commodity too, but it's very difficult to say one rate would be equal to another. But if you're talking about a commodity barrel like Brent or WTI or ultra low sulfur diesel on the CME, you know, then you're talking about the same barrel. However, when you're talking about futures markets now in this sort of crazy market, you're talking about, let's say, barrels now for ultra low sulfur diesel on the CME are trading now for July barrels. And increasingly, the concern is what's going to be like by the end of July, what's going to be like maybe early August. And that was really brought home last week at the Sanford Bernstein Industrial Conference when Mike Wirth, who's the CEO of Chevron, and I'm drawing a blank on Mr. Chapman, I'm sorry, of ExxonMobil, I guess Neil Chapman, I guess, both took to the stage for a fireside chat. And they don't usually talk about price. Oil companies are kind of loath to talk about price. First of all, they realize that they have no control over it. And secondly, they tend to get their lawyers get really upset about that because it could be seen as signaling. But both of them were kind of delivered the same message that we have actually avoided catastrophe so far in oil markets because we had so much in inventory. We had normal inventories, and then we had a lot of what's known as oil on the water. And that's being run down pretty rapidly. And we're getting close to what is known as tank bottoms. Tank bottoms are not zero inventories, but they're kind of like the minimal level you need to have the system operate. So inventories include, let's say, the line fill that's in a pipeline. Well, you can't just empty that out. So they both express concern that, and this is, I say concern, the price of their product is going to really soar if this happens, that without any fairly rapid movement out on the Strait of Hormuz issue, that you're going to be down at tank bottoms by sometime in July. So this is really kind of bizarre. It was really bizarre last week. You had these really stark messages coming from major oil companies, people who really know the market inside and out. That was, I think, extremely bullish. And the market just kind of shrugged its shoulders. And it went down several days in a row. It really didn't come up until yesterday when it moved significantly higher. When I say it, I mean, Brent and WTI and diesel and gasoline. And then today, the last time I checked a couple hours ago, it was up a little bit, but not much. So the market right now does not seem to be buying the concerns that you heard expressed on that stage in at the Sanford Bernstein conference. It's a real dichotomy.
John, do you find it strange that this is the largest oil disruption since the OPEC crisis in the 1970s, and yet WTI is hovering around $90 a barrel? It just strikes me that is somewhat unusual. Again, you track this market as well as anybody does. I mean, that seems strange that we have fairly affordable oil, particularly when you look at it on an inflation-adjusted basis.
No, I would agree with that. I would have not thought that $90 would have still been the case this many months after the whole Iran war started and the Strait of Hormuz was shut. I mean, there are two theories on that. The theory is that what I mentioned before is that we had a lot of oil in inventory. They were, the supply demand models coming into 2026 were all extremely bearish. So we were really out of whack in favor of the consumer as we came into 2026. So there's that theory. There's also, again, and it's kind of tied to it, a lot in inventory, particularly on the water. And I just was reading something recently that we may be destroying demand faster than we thought we were, even if it's not happening so much in the U.S. because we've been able to kind of get everything. We haven't any real shortages, but that in other parts of the world there have been some supply squeezes, some I don't know when I say rationing because that sounds like the government got involved, but some lack of availability, which may be cutting demand. So it's possible that the world is reacting to with the demand destruction faster than we thought. But let's face it, we're going to get this test then, based on the statements by Mr. Worth from Chevron and the gentleman from ExxonMobil. We're going to get a test in 4 to 6 weeks about where we really stand.
So, John, you've also been tracking another story around driver pay and Nussbaum Transportation being the first to publicly announce raising driver pay. Wondering if you think others will follow and what you're hearing.
Well, I'm just going to go back in history, as I mentioned in the story. So last week, Nussbaum Transportation, which is a Midwest, mostly dry van carrier, came out with a press release saying that they were increasing pay. Now, mind you, nobody has to do this. You don't have to put, sorry about that. You don't have to put out a press release on this. So I looked at it, and I remember writing the story by Schneider in like September or October of 2020, press release saying they were increasing pay. Again, this was kind of abnormal. Remember, 6 months earlier, we were in the grips of COVID. And Schneider's release back in 2020 seemed to kick off a whole bunch of similar releases. And we at FreightWaves wrote about all of them. So when I saw this Nussbaum thing, I looked around and I could not find any other companies that had done that. I reached out to Nussbaum. They actually spoke to me, which was really good for a private carrier. And they said, yes, they weren't necessarily sure they were the first company to increase pay, but they thought that they were the first one to kind of announce it. And even after they announced it, they said, some people got back to them and said, oh, yeah, we had to do that too. So then I talked to Leah Shaver of the National Transportation Institute. They're a service been around a long time that tracks driver pay. And they said, yes, they certainly had some anecdotal evidence of some driver pay increases at some truckload carriers. So, yeah, I think that if I don't know that this is a one-off, I just think the Nussbaum thing might be a canary in a coal mine. That driver pay is probably increasing, and it makes sense. When you've got a market this tight, and when you've got rates going up that high, the driver pay is going to follow. So I don't know that it's a leading indicator, probably a lagging indicator, but it's definitely going on out there.
Yeah, I think that's really what I was going to follow up ask. Do you think it's inevitable for other carriers to be forced into following suit and also raising driver pay as the recruiting market gets harder and harder in such a good freight market?
Right, because a driver can, if they've got their own truck, they can choose to go over to become an independent operator. They can go on lease or something like that, and they can really take full advantage of these higher rates. If you're a company driver and all the advantages going to the company, well, that may eventually incentivize you to go out on your own. The companies can't have that if they want to have a good, robust fleet of company drivers. So, yeah, again, this is going to be a lagging indicator, not a leading indicator. So it makes perfect sense given the kind of numbers we've been seeing on rates, which I'm sure you probably talked about earlier in the show, right?
Yeah, Aaron, Graff was on earlier from Triumph. I know you cover Triumph on the editorial side, just talking about he's gone out and done a tour of his customers and said it was, almost every large fleet that he talked to was talking about expansion, which, you need drivers to do that, John. I take a little bit, I'm all excited about drivers getting higher pay. They deserve it. Many of them have been left out of the market for the last couple of years because of this oversupplied situation. And a lot of fleets haven't had the opportunity to raise pay for drivers because, frankly, they didn't have enough freight to do that. They were just trying to survive. And now that we're out of this freight recession, everyone's thinking about expansion. I hope that we don't overcorrect. Aaron certainly doesn't think we will. What do you think this means? I mean, it's just like the airlines. When one company has to raise pay, everyone's got to follow, John.
Yeah, that's right. I really wonder how many people saw that Nussbaum story and said, "Oh yeah, we may." Well, they were already thinking about doing it. They already had done it. They were thinking about doing it, and maybe they're not thinking, "Well, we got to keep up with Nussbaum." But maybe they also came to the conclusion that a company that's publicly announcing an increase like this is not the only one doing it. I thought it interesting. The Nussbaum, when I spoke to them, they were really high on the fact that they were implementing profit sharing, which they had never had before. It's not like they were going back to a system that they used to have and stopped when the freight recession hit. Things were so tight right now. This is another way of compensating their drivers. They're going to have a profit sharing. So that to me is a sign that they're doing more than just tacking on a few cents per mile. They're making it much broader than that and giving the drivers a stake in the business.
Yeah, and also Nussbaum is an ESOP, and employees they have an ESOP plan. It's employee owned, so this is a chance to sort of share in the not just the big company, but share the profits and the opportunities for the market. John, so many stories are really driven on the economics of this business. With everything you're seeing, one of your favorite reports is the BMO report. I know you are as sad as I am that we won't have any more BMO reports. I know, for those that don't know, John tracks the default rate, a very technical thing, in the reports. What are your thoughts in terms of losing your favorite report?
Well, I actually had an off-the-record conversation with it's called Stone Peak, the company that is buying the BMO transportation business. And when the call started, I made it quite clear to them that I was against this deal, and they had to call it off immediately so I could continue to get BMO's numbers. But unfortunately, they didn't listen to me. They're going to go through with this. So BMO will be coming out one more time, I guess, with its numbers. I'm assuming. So this would be May. So the end of July, August, the end of August, I assume, we'll have one last shot at their transparent numbers about the state of credit conditions in trucking. I would imagine by the November one, where BMO's earnings comes out at the end of November, I'm assuming this deal will be closed by then, and we will lose this wonderful little number or several numbers that gave us transparency into credit conditions. I will say this, that the numbers never really diverged from where we kind of thought they would be. And when things were bad, they showed that they were bad. But it was interesting is that there was a lag. That even as the freight recession was taking grips in 2022, their numbers through 2022 were still pretty good. The default, the number of write-offs and the problem loans, et cetera, hung in there. And you took my tweet and you sent it out as well, noting that even though the last report even though the last report came in the middle of this booming market suddenly, their numbers didn't show that. So clearly there's a lag either way. And I think if we can take out any lesson from these several years of having this BMO data, it's probably that credit conditions are not a leading indicator. They are very much a lagging indicator. And there's going to be some time before trucking companies get into trouble and it starts to show up on the sheets of their bankers.
John, real quick, you have 10 seconds. Give us your predictions on the fuel market.
Oh, I'm going to go with the gentlemen from Chevron and Exxon. They don't normally talk that way. They don't like to talk about prices. They got up on a stage in New York last week and they said things could get really bad. I'm going with them.
Of course they do. They're bullish because they own the oil. So that's why we're going to see that.
I know. Come on, that's the too cynical way.
I don't think it's cynical. There's a lot of optimism.
If you're running an oil company, you know that you're not going to get. If your whole model is, well, the prices have to get higher, you're screwed. I mean, you have to operate your oil company as if the prices are going to be sort of moderate. And they're getting this bonanza, but at the same time, there's no reason that this kind of chaos is kind of good for the short term, but in the long term, it destroys demand. Let's remember something. Going into this year, every single model out there, every single supply demand model out there said the same thing. One of the reasons the price is keeping relatively restrained is because, again, back to that marginal barrel, right? Our talk will come full circle. That marginal barrel is increasingly going electric. And this is probably going to accelerate that. So it's not that you have to have 30, 40% of your fleet be electric. If that marginal barrel that that marginal bit of demand that used to get supplied by petroleum is now getting supplied by electrons, that matters. And so in these oil companies, they're gonna get some great profits and great revenues and all this, but they're concerned too that it doesn't end up with a switch that they don't get back. So that's in their model too.
All right. Thank you so much, John. Always incredibly educational to hear from you. We're going to take one more quick break, but when we come back, we're going to hear from Jeremy Donahue, truck product director from U-Haul, as they roll out their new 29-foot Easy Mover.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
The map is changing. As global uncertainties rise, the future of the supply chain is moving closer to home. Welcome to the new coast-to-coast North American network. Driven by massive reshoring trends and next-gen industrial innovation, optimized by AI workflows that build unshakable operational resilience, and locked down by proactive security against evolving freight fraud. Are you ready to navigate the shift? Join the industry's top minds to build the future. The FreightWaves Domestic Supply Chain Summit, streaming live June 17th. Register for free at live.freightwaves.com.
Welcome back to FreightWaves Today. It is almost day two. Our last interview is with Jeremy Donahue, the truck product director of the most famous transportation company out there, U-Haul. Jeremy, welcome to FreightWaves Today. We're excited to have you here.
Appreciate it.
So Jeremy, you guys have a brand new product that you've just released, a 29-foot truck. Who is this targeted to?
This is people who are moving 46 bedrooms, larger homes or apartments.
Yeah, it's amazing to me. I moved out of a house and I saw the amount of rooms I had and all the furniture, and I was like, there's no way this fits inside of a small truck. And man, can people pack it?
Yeah, some people, pack a little bit different than others, and you never realize how well you pack until the end.
Tell us a little bit more about the decision to move from the 40-year history of a 26-foot truck to this new 29-foot truck, and what sort of led that decision-making process.
Well, we didn't really move from it. So 26-foot truck is still a staple within our company. This is not meant to replace that truck at all. This is meant to add another option for our customers. U-Haul is a gasoline-only fleet, and we, talking to Cummins for a long time, and they finally came out with this V6 7-octane, and we wanted to see how well our customers respond to it, if it helps, our customers out. So we decided to put some in the fleet.
So Jeremy, I've got to ask, so much is happening with moving. You guys always have these great reports of where people are moving, where they're moving to. Tennessee has been a big recipient of a lot of folks moving. What does the movement of America look like?
You know what? I'm more of a nuts and bolts person here for U-Haul. I wish that I could answer that question for you, but I'm not really sure of that.
So Jeremy, tell us a little bit more about what you guys are trying to accomplish. You got a bigger truck. Is this replacing potentially two trucks that they would be normally, or two trips? Is that sort of the idea here?
Yeah. So we try to tell people that if you get the bigger truck, you have less trips, you use less fuel than you do with a pickup truck. People will go out and do 4 or 5 trips. If you used one of our trucks and you fit all of your stuff in there at one shot, then you save more in fuel, you save more on time. We have our trucks are our moving trucks are, they're supposed to be for us, and we don't have like a second life on them. It sets us apart a little differently. We have very low deck heights to step into. It's a little bit more automotive-like than other trucks that are out there. So we're really just tailoring these things to the do-it-yourself mover and giving them an option to carry more things.
Right. Yeah. So the bigger size, you're talking a little bit about how to make it more accessible for people who might be intimidated to drive even a bigger truck than what you've been used to in the past. So in addition to them being gasoline versus diesel, lower deck height, what else makes it easier for kind of your everyday driver or consumer who might be used to driving an SUV be able to do this as well?
So some of the things that we do is we make all of the controls, we want them all out in the open and intuitive for the customers. The door handle in this truck is specifically is pretty low. The step-in height is pretty low. The The hood of most of our trucks are really short, and actually all of our trucks are really short. So you sit up high, so you get a good visibility of the road that's in front of you. We have hydraulic brakes, so there's no air brakes in our trucks. There's no air button to pop when you park it. It's an automotive style transmission where it has a park a position on the stalk. The wide range of seating adjustments to fit all sorts of different people. The suspension is spec'd so that it's not like a very heavy truck. It's meant to be at 26,000 pounds, where some other trucks may not be.
All right, great. So one final question. I read that it's as low as $49.95 for in-town moves. Where is it available now, and when does it roll out nationally?
We're rolling them out in Pennsylvania, near the Philadelphia area and Long Beach. And as we finish these trucks and they get built, there'll be more coming out after them. I don't have a schedule for our next build for these trucks, but you should be seeing them soon. People tend to move into the inside of the country from California and from Pennsylvania, so you'll be seeing them in your neighborhood soon.
All right. Thank you so much, Jeremy, from U-Haul.
Thank you.
So great to hear about what's happening with you guys.
Now, Julie, have you driven a U-Haul?
No.
I've driven a U-Haul. My wife has actually driven a U-Haul. Now, my wife always insists on driving, which in itself is an experience. But
no, I never choose to drive if I have.
My wife always insists on it, and we'll just say that I'm glad when she gives me the opportunity to drive.
Listen, I just got rid of my third row SUV because I didn't want to drive something that big anymore because I am not good at it. So I admire that this is made easy to drive and that people can do it, but I think I wouldn't get to lean on my husband for that one.
Yeah, well, there's always a job for us out there. Next up, we are going to go to break. We got a few seconds, and we will be right back to give you a sense of what we're seeing in the market and talk about what we're coming on the show tomorrow.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Julie, day 2 is wrapped up. We had a great show. What did you think about today's guests? We had some amazing guests today.
I thought the guests were great. I think that we got to kind of reaffirm some of the things we heard yesterday. I think that a really clear picture of what's happening in the market is coming to light as we see from different angles of it, from the financial angle and the banking angle. And we talked about it from trucking operations angle and a little bit from a brokerage and intermodal angle. And I like that we're kind of filling out that whole picture.
Yeah, it's been amazing. And Jeff coming to town to talk about STG story. I mean, company that's been through a lot. Bankruptcy's obviously, he said it wasn't tumultuous or wasn't stressful for him. He certainly better positioned. I imagine that's a lot. But he's got opportunity to really, show up, as I guess my son said, pull up is the term that the kids say these days. Right. Pull up in this market. Which is a term I didn't know what it meant, but it is young people talk. Tomorrow, we've got a great show as well. We have Tom Medine, the CEO of ShipStation. By the way, in the news cycle, we learned that Worldwide Express and ShipStation have merged, and he's going to tell us all about that. He's coming in studio. I love when guests come in studio.
Me too.
And we've had one every single day. And then we have Dennis Montz, the president and COO of Pay Cargo Labs. Going to talk about paying for cargo and payments and payment rails. We had Aaron here today. So we've had a number of interviews. Is there anything that you stuck out of the last 2 days?
Oh gosh. I'll tell you one thing that I am interested to hear about tomorrow.
Okay.
I am interested to hear about AI and how we think if it is going to lead to more mergers as processes and operations can be automated a bit more, if there will be more mergers coming out of that, similar to the newsreel and WWEX and ShipStation. So
yeah, Worldwide Express and ShipStation. ShipStation, I know them from their commercials, obviously trying to get stuff out in parcel. Worldwide Express is the only reseller of UPS's parcel business. And what's interesting about it is we have a freight person running ShipStation, which I think is cool.
Awesome.
Worldwide Express is an amazing company. We're big fans of it. Now it's called ShipStation Global. We're going to hear all about that story tomorrow. So much is happening, Julie. We have an amazing market. My favorite part of today was, in addition to our guests, was learning what the LMI is saying. We got to dive into that tomorrow. Can we do that?
We absolutely can. I'm excited to... You guys know I am not a newscaster. I'm getting comfortable with this.
No, you're not amazing. This is day 2.
Day 2 is better. I am a data and market and transportation person, right? So I really get excited for the days that the LMI comes out and get to look at it. So yeah, I'll be thrilled to talk about it tomorrow.
You got to begin the trenches you had been, and now you're driving it with data, running Sodar's data business. This is a remarkable time. Intermodal. I love when we get railroad people that can talk about railroad, just everything that's going on. It's such an interesting product with fuel prices, getting point-to-point transportation around the country. All of that, I think, is pretty remarkable. Is there anything else that has really caught your eye over the last couple of days that you think is just incredibly interesting that perhaps you didn't expect? I think the Estes conversation yesterday still sticks out in my mind of the fact that consumers, because everyone expected, John Kingston teased it just a few minutes ago, that there is belief that oil prices are going to continue to go up. Now, he was I'd say not protecting, but getting a little defensive when I called him out on that. Of course, the oil companies want it to go up. But having said that, I also think it's not showing up. It's showing up in inflationary data, but it doesn't seem to be cooling the consumer.
No, I think that that's going to be the most interesting thing to watch, as we have talked about a few times today, and as we'll talk about tomorrow on the LMI, is that as manufacturing has gotten strong, retail's recovering, as consumer demand continues to recover, then there's just one more sign pointing to your super cycle you've been talking about. So
Trucking super cycle. And
excited to talk about those details in the LMI tomorrow.
You can watch the Trucking Super Cycle live inside of Sonar and hear about it on FreightWaves Today every single day. And if you miss this show, don't worry. Road Dog is on SiriusXM, and we will replay it on demand every single day.